Good morning, everyone. This is Latoya Poe, your mentor here. And today I want to talk about what we've been talking about, trade. All we've been talking about is trade. And so, um, for those of you guys who are still struggling with lot size, let me give you an even better solution. I know I mentioned dividing your capital by 1,000, trading gold, but if you want an even better cushion, you want a cushion that gives you the ability to trade without a stop loss, then you got to go a little higher. When I say higher, you got to give yourself a lot more spread. Sometimes, like I don't know where you guys are, but I'm in Michigan, Detroit, Michigan to be exact. Um, and if you go to the fireworks, if you're too close to the fireworks, you can't really enjoy it because it's so loud. The ash that comes from the fireworks is not good for you. So as close as you may be, and then on top of that, when it's time to go, you gotta wait because there's so many people and so much traffic to leave the area. Same thing will come with trading. You can enjoy trading from a distance. Okay. How do you enjoy trading from a distance? You enjoy trading from a distance by giving yourself so much space that you can still see the fireworks, but not be bound by the location of where it's actually happening. So, as I said before, we divide the capital by 1,000. But if you want to go a little even better as far as giving yourself space, you can divide it by 2,000. Now, somebody would say, well, why would I divide it by 2,000? Well, it's because you don't want to feel you don't want to feel the effects of the drawdown. You don't want to feel the effects of being right but being wrong only because your trade was too big. Your margin you was too close to margin call. So to put it in trader talk, you were too close to margin call with the trade size you decide to take, the lot size you decide to take with the capital that you have available. Okay. You're too close to being margin call. Margin call is the location of the uh, danger of the market when you're no longer when you're no longer able to benefit from any movement in the market, you get margin called. Margin called. Um, your trades are closed out, and your account takes a loss because you're too close to the margin call territory. So in order to stay away from margin call territory, you have to give yourself space. All right. Now we know moving average cross strategies work. Most times, moving average cross strategies don't work. They're not implemented correct because people who trade the moving average cross strategy, they trade too close to the margin call. I'm one of them. And that's why I'm bringing this to you because it was brought to me. You're too close to the margin call. Most traders are not bad traders. They're just too close to the margin call. All right. So imagine, right, a trade like this where you see the moving average cross and you may have, and this is going into my the approach, right? You can't have less than you can't have to do this strategy. You got to have at least $200, right? Now you can have $200 of your own money, or you can do it like this, which I'm getting ready to do. You can have $200 of prop firm money. So let me go ahead and pull up so I can share my other screen. You can have, excuse me, $200 of prop firm money. Okay, you got to have at least $200. So with this on FXify, you can um this is the one phase. You don't need to do no two phase. If you want to, that's your prerogative. For one phase, right? You need at least 300 $200. So this one would be the account suffice. I wouldn't do an instant funded account because you basically just get double of whatever you put. It'll cost you more to get the $200 than it would if you just do the one phase, right? Minimum trading days, 5 trading days. And here's a cool thing, guys. We're going to practice something that works. So with this $71.21 using this code, um, you will get 3% of 10,000, which is $300, right? That's all you need. So you can do it. You can put $200 on an account yourself, or you can take $71. I think it's a little bit more of a fee when you do it, probably like 75, 76 bucks, and get access to that same amount of money, actually more, right? And then from there, you don't have to worry about the 3% because you're taking the 3% that was given and you're dividing that by 2,000 to even take your trade, right? So the max random drawdown, we're killing all of we're not even we're operating as if the 3% is all we have. Because in actuality, guys, I don't care what the size is, your dead the daily loss limit, which is the limit where they shut your account down, that's really all they're giving you. All this is fluff. Okay. That's like having a mansion, but you really only get to stay in one room. It's still a good view, but don't let the big numbers fool you because this is all you got. If you lose your room, you lose access to the mansion. If you lose the 3%, you lose access to the 10 grand. Okay, but let's go back to where the play is being uh, shown. So let's go here and share back the screen. Okay, so this is a cool thing, and not to mention you can trade weekend. You can hold over the weekend for the one phase account, and you can trade through the news. Okay, so let's just say now the goal. I think the goal was let me go back and see, make sure I saw that right. The fund to get funded, you gotta turn that 300 into a thousand, which is nothing. Let me show you how. Let me show you why. Okay, so let me show you why it's nothing. All right, so you got $300. You're trading. You divide that 300 by 2,000, you get 0.15, but you can't do a 0.15. So you do a point 0.1, right? The same thing that we would do with the 200. Okay, the point 0.1, you enter. This is how the same thing I've been talking about the last couple of videos. After the moving average cross, you wait for a candle to close in the opposite direction, so it's crossing down. You wait for that bullish candle to close, and you continue into the trade. Right? There's a minimum of 5 trading days. One, two, three, four, five. Okay, so you do a point zero 0.01 here, and you hold it. That's five. That's 500 right there. So that you made 500 just off one trade off the point zero 0.01, right? Now you have $800 to play with. You take that $800 divided by 2,000. That's the play. 800. So you go from. This is why you need to have the understanding as to why it's better to do this. It may take a longer time, but the goal is just to get funded. Once you get funded, you do what you got to do. But I would still promote the same process. Okay. So this what I'm talking about here is to get funded to show you why it works. Okay. So you go from there to here with about that point zero 0.01 takes your you go from 300 to 800. Okay. And I think 800 and I don't know if it's 800 in funds or whatever, but whatever the case may be, even if you just traded at point zero 0.01s or point zero 0.02s, you're still good. Okay. So from here, this was 500. It comes back up here. You enter with a point zero 0.02 and it goes down to there. That's another 1,000. So you make 1,500 off 2 trades within 7 days. 7 days. Okay. 7 days, 2 trades. Both trades were less than point zero 0.1s. And for you fund it because the goal was to make 1,000. You made 1,500 in 2 trades. Okay. Now let's go back to now obviously there are some limitations with the amount of money that you can move with the prop firm, but you still take the prop firm money, do what you can, and then once you make the prop firm money, you can go and do what we're getting ready to do on a real account. So in the same case, if we take the 200 divided it by 2,000, we would get zero point zero 0.01. Zero point zero 0.01 down to it's like almost 5,600, 5,000. That's 500. So now you go from 200 to 700 in profit. You divide that 700 by 2,000, that gives you 0.35, but you can't do a 0.35. which is 35 cents. So you got to do 30 cent a pip. So you do a point 0.3 here, point 0.3 down to another 5,000. That's 1,500. So you go from 200 to 700 to 2,200 in two trades, and you're still dividing your capital by 1,000, 2,000. That's all. That's all you're doing. Okay. So, and this is obviously swing trading or whatever. Okay. So same thing. These moving average comes across. Once it breaks under and closes, now you mind you just doing what you know, right? So you had to that 200, 700, 2,200, and you divide your capital by 2,000, you're a dollar. That's point one. Point one here, that's another 1,000. So you're not. It's a peaceful approach because you're not close to margin call. You're making money, but you're nowhere near close to margin call. Right? You can be more choosy with your trades. You can actually apply your principles better. And the biggest thing is you're not close to being margin call. Okay. Now, if you want to go to where you can see it on the daily when you do intraday trading, same thing. It doesn't matter. You see something, all right. For example, um, especially with the trades like this where it doesn't even go up through, you already got what you leave for, what you're looking for. Um, Once you see a candle that's going against the trend, once that candle closes, you sell. Especially now, here's the thing. I will say this: you don't want to do that down here. You want to wait until it comes close to the moving averages because if you do that, for example, if you do that, and I've seen a couple times where even in the progression of the the move, if you do that down here, it's not going to work. Why? Because you, for one, you're way too far off in the move is way too far away from the moving averages. You better are waiting to see if you get another opportunity uh, after price comes back into the moving average area to see what's going on. If it's too far gone from the moving average, it's not going to work. It's better off to wait for it to come like this one, right? Even though it worked long time, there's still a lot of time of limbo. It's better off to wait for the price to come here and then do that than to take the trade here because that's almost 700 pips gone from the moving average. Okay, that's really all there is. You just do your take your time, and I always write stuff down. Um, but from $200 dividing the capital by 2,000 within 2 or 3 months, you can easily make 3 grand, 300 grand, right? And that's being super conservative. That's not trading every day. Because you're still going to. It doesn't matter what you divide your capital by. I don't care if you divide your capital by 5,000. You're as long as you are trading in the right direction, you're getting the trades right. You're gonna reach the goal. It may take longer, right? Whatever your approach is to having a safe trading journey, whatever you desire for your seatbelt to be, whether that's and when I say seatbelt, that's an analogy for what you divide your capital for. Margin call is the equivalent of having a car crash, right? Where your car is damaged, you got to go to the hospital, you got to recover. Okay, you don't want to be close to margin call, right? And with a volatile market, having a volatile trading in a volatile pair, it's like driving a hypercar. For example, gold is like driving a Hellcat or driving an AMG Mercedes or a Bugatti, whatever you think, whatever is a fast car to you, a Corvette, right? Now you don't want to drive a Corvette or a Bugatti without having what brakes and without having seatbelts, right? So and then obviously, like I said earlier, you don't want to be close to a merger cost, which that means you have to be able to drive. I don't care how fast your car is. If you want to have the best probability of not getting into an accident, you got to be aware of the speed limit. You got to be aware of your surroundings, all right? And so when I'm saying being aware of your surroundings, you have to be aware of the environment that you're trading in. If you're trading on a gold, you can't trade gold like you trade on the GU. You can't trade gold like you trade on a pair that's not as volatile, where you can divide $100 and take a point one on the GU or a new a NU, New Zealand dollar versus USD. You can't do that anymore on gold. Now, there was a time when you could trade it, take $100 and go right into trading point ones, which is a dollar per pip on gold. But that time it hasn't been in about a year, 2 years or so. So you got to be able to adjust after taking the losses, adjust, see where it came from. If the loss came because you were close to margin call, then you got to give yourself some space. If the loss came because you took this, your strategy was wrong, then that's something you got to be able to adjust. Trading is about trading is about adjusting, all right? So, like I said before, if you whatever you have, $200, just like for example, $200. Now we know with the moving average cross strategy, as soon as the moving average cross goes, you can find something like this, right? Now that's a good. This is what I was saying, especially with 2,000 pips. You're not getting a 2,000 pip drawdown, right? But um, if you still want to be safe, wait for it to come back. Wait for it to come back to the area where it took off at. Right, it took off from here. That's why you see it came right back to this area because this is where the initial move started. It didn't start here. It started here, right? It started there, it pushed up. So even when this coming back here, this is where the move progressed from. It took its time, but it progressed here. The key is this: moving averages is your guide. It's your guide, right? So if you got here, you got 200 bucks. 200 bucks. You enter here with a point zero one. That's 1,000. It don't look like it, but that's 1,000 pips, right? At this point on gold, that last number, especially with them not using the penny anymore, that last number is that two, that 11352, as far as points, that two is 20 cents. The 1135 is the dollars, right? So that's 100 bucks. You got 300. It comes back down. You get in with a point one. So you don't have enough to divide to get a point 02 yet. So you do it with a point 01. Point 01 was that another thing. Now you have 400. Now you can go in with the point 02. The point 02 to the upside, that's another 48. That's another $480. So you're getting the growth without any fear or any worry about losses. Okay, real simple stuff. Okay, none of this is hard. Like I said, the biggest thing for most folks is you're just trading too close to margin call. Your trades are too close to being margin call. You should never see 70% warning, margin call warning. You shouldn't see that. If you're seeing that, that is what's throwing your strategy off. The fact that you're trading too close to being margin call, that's really the pressure that you're putting yourself under. If you was trading with a space that was, you should never see that. You should never see that. If your strategy is right and your uh, risk to reward management, and not even risk to reward management, if your strategy is right and your capital, your lot size is right based on the capital, you should never see a margin call warning. Margin call is the result of two things: your trade, your trade being wrong, and your trade size being too big. Because you can have the trade be, like I said before, your trade can be right. But if your lot size is not in a place where you can handle any fake outs, then it's going to give you the same result of having your trade being wrong, and that being your trade close, your count blown, um, capital lost. Okay. So, like I said, guys, this video is not going to be long. So, really, a pickup from the last couple of videos, but you can do a lot by dividing your capital by 2,000. Okay. I'm not going to go through and do the numbers um, as I would normally do, but just take the time, back test from 2,000, back test with $200, divide your capital by 2,000, and obviously you can't do a 0.035. You have to adjust that based on what you know about trading. Okay, so this video, like I said, is one that help you see where it could be fixed, what is going wrong, and be able to decipher whether or not uh your strategy is wrong or your lot size is wrong. And when you figure out if it's your lot size, most of the time it is your lot size. If you've been doing this for a while, it's the lot size. Divide your lot size by a bigger amount. For me, it's trading gold. I'm dividing it by 2,000 and let time work for you, not against you. So you guys have a great day. I'm gonna post it to my YouTube channel and then I'll post it to my Facebook group. All right, I'm out.